So, Chris, we hear the term risk capital. Can you tell us what that is and how much risk capital would a SPAC sponsor need?
So risk capital, well, let's first talk about what's the no risk capital. No risk capital, when the investors put their money in, that money stays in a trust and doesn't go anywhere, right? And so at the end of the deal, of course, as most people know, they have an option to redeem those shares, and there's usually some interest component. However, that money doesn't cover all the fees that are associated with an IPO. So you have your legal, you have your accounting, you have your underwriter fee, you have your NASDAQ fee, you have your but perhaps some ongoing management fee, like maybe your CFO is doing the Qs and the Ks, things like that. So that at-risk money is designed to cover all of those IPO costs, and then also the operating cost to get you through the de-SPAC. That's all the due diligence fees. Sometimes you need a fairness valuation, all that, right? So we're seeing the range, what we feel is we add up all the potential expenses that can occur from IPO to de-SPAC, and we're seeing those ranges come in between 1.8 million and 2.3 million, which is a lot of money. And so one of the things that we've helped work with issuers or potential issuers over the last couple of years is forming syndicates to help participate in that sponsor capital. And the way that works is you can bring in a small group of investors to possibly reduce that amount. So say, for example, your total at-risk pool is going to be $2.3 million. The syndicate might be willing to bring $1.5 million to the table. Well, then the SPAC sponsor team might only need $800,000 in that case to bring to the table. So it ends up becoming more budget friendly. Now, the give and take in that situation is the SPAC team typically has to there's a negotiation that'll take place with the syndicate on the founder shares. And so they're not just going to want to buy sponsor shares normally at $10 and be at risk when everybody else is not at risk, all the other $10 investors. So you're typically, the give and take there is you're incentivizing those folks in the syndicate by giving them some of the founder shares that you have in the founder share pool.